The dogs of the Dow strategy did not seem to work last year, even though it did work in 2010 and 2011. The 2013 dogs of the Dow are at&t, Verizon, Intel, Merck, Pfizer, DuPont, Hewlett-Packard, General Electric, McDonald's, and Johnson&Johnson. Patty, would you consider the strategy this year? And if not, are any of the dogs individually appealing to you?
You know, when I look at the dogs of the Dow, I think that's an interesting place at least to start looking, just because of the valuation on some of those names that you mentioned. Some of those names got beaten down, we think, unfairly because of political pressures. The thought that perhaps the dividend tax rate was going to go up to 30 or 40% as opposed to the 15% that we had enjoyed going forward really put a covering over those stocks. Now that that's been lifted, you've seen a decent rebound in some of those, but we still see some good values in there. For example, McDonald's, we see 9% upside, and then on top of that, you've got over a 3% dividend yield on that. Johnson&Johnson, same thing, about a 9% upside just in capital appreciation. You add on the dividend yield, you're looking at 12%. If you could make 12% in a stock anytime in the past couple of years, you've actually done fairly well. And so I think you use that as a shopping list, but you don't necessarily buy the strategy outright.
Let's talk about the two telecom names, at&t and Verizon. Last year was a strong year for both names, and they still offer relatively nice yields. Lee, if you don't own either of these stocks, do you get in now?
Well, you know, I mean, I own some at&t in one of our core equity portfolios. It just sits there. It's a sort of an anti-stock. It's there to give a good dividend. But I think that the overall dividend plays are overhyped. I think that if now it's 2013 and you want to, you heard about how, dividend growers are doing well, I think that you've missed the boat. It's an overcrowded trade. Talk to people from S&P, talk to people from MSCI. They'll tell you that those big indexes that cover dividends, the dividend achievers, all that stuff, they're crowded. We like at&t. It's one of the few dividend plays. But in terms of the dogs of the Dow, that whole place, like, where's our Union Carbide? Where's Tylenol? The dogs of the Dow was about things blowing up. None of those companies there are yielding 8%. None of them blew up. And I think that's why the strategy may not work this year. So I think that if you're going to look at a dividend play, remember, it's a crowded market. We own at&t for very specific reasons. But I think if you're just trying to find yield, forget it. Don't find yield. Go find a real company.